Introduction. The time value of money, TVM, is one of the cornerstones of corporate finance. It reflects the principle that a specific amount of money today is worth more than the same amount in the future because of its potential earning capacity. Understanding TVM is critical for valuing investments, assessing loan repayments, and making sound financial decisions. The concept of interest rates. Interest rates represent the cost of borrowing money or the return earned on an investment. They incorporate the opportunity cost of using funds today instead of in the future. Inflation expectations, which erode purchasing power. Risk premium, compensating investors for uncertainty. The interest rate used in TVM calculations is often called the discount rate or required rate of return. Present value, PV, and future value, FV. 3.3.1 Future value. The amount an investment will grow to after earning interest over time. Formula for compound interest, FV equals PV times 1 plus R to the power of N, where PV equals present value or initial investment. RR equals interest rate per period. NN equals number of periods. 3.3.2 Present value. The current worth of a future sum of money, discounted at the appropriate rate. Formula. Point PV equals FV divided by open parenthesis 1 plus R close parenthesis to the power of N. Annuities and perpetuities. Annuity. An annuity is a series of equal payments made at regular intervals for a fixed period. Ordinary annuity. Payments at the end of each period. Annuity. Due. Payments at the beginning of each period. Present value of an ordinary annuity. PV PMTX 1 via 1 PR N RPV equals PMT times left parenthesis 1 minus 1 times 1 plus R to the power of N right parenthesis divided by R yard frac 1 plus R num right on DIVR, where PMT is the payment amount. Perpetuity. A perpetuity is a stream of equal payments that continue indefinitely. Present value of a perpetuity. PV equals PMT divided by A num I. Uneven cash flows and net present value, NPV. Often cash flows vary each period. The present value of uneven cash flows is the sum of the present values of each cash flow. NPV equals the sum from TT equals 1 to N of CFT, divided by 1 plus R to the power of T. Where CFT equals cash flow. At time, TTRRR equals discount rate, NPV, is a key metric used in capital budgeting to evaluate projects. Internal rate of return, IRR. The IRR is the discount rate that makes the NPV of all cash flows equal to 0. It represents the expected rate of return from a project or investment. A project is generally accepted if its IRR exceeds the required rate of return. Discounted cash flow. DCF valuation. DCF is a valuation method that estimates the value of an investment based on its expected future cash flows, discounted back to the present value. The formula is DCF equals the sum from TI equals 1 to N of CFT, divided by open parenthesis, 1 plus R, close parenthesis to the power of T. DCF analysis is widely used to value companies, projects, bonds, and stocks. Examples. Example 1. Calculating future value. Invest $1,000 at an interest rate of 5% per year for 3 years. FV equals 1,000 times 1 plus 0.05 to the third power equals 1,000 times 1.157625 equals 1,157.63. FV chosim 1,000 times open parenthesis 1 plus 0.05 close parenthesis cubed equals 1,000 times 1.157625 equals 1.15763. Example 2. Present value of a $10,000 payment. 5 years from now at 6% discount rate. PV equals 10,000 times 1 plus 0.06 to the fifth power equals 10,000 times 1.3382 equals 7,472.58 PV. Frac, 10,000, ranks 1 plus 0.06 to the fifth power. Or frac, 10,000, ras grant 1, 382, 7472, 158. Summary. This module establishes a fundamental understanding of the time value of money, including concepts of present and future value, annuities, perpetuities, and the foundational valuation techniques used in corporate finance. These concepts underpin capital budgeting, investment analysis, and asset valuation.